bastante prometedora. Nosotros seguimos con el análisis de este dato de IPC, que como decimos ha sido muchísimo mejor de lo esperado. Veremos hasta qué punto esto le da cierto alivio a la FED por un lado y también a las bolsas que están pronosticando, que prevén en estos momentos que la Reserva Federal pues se va a relajar un poquito. Esto, por supuesto, se traduce en buenas noticias para la renta variable. Así que vamos a saludar a Lance Roberts, ya lo tenemos con nosotros, es estratega jefe de Ria Advisors. Lance, thank you so much for having us a few minutes. Good afternoon.
Afternoon, thank you.
Lance, inflation cooled more than expected in October in the US, positive surprise for equity markets and, of course, for the Fed, which is your main reading of this data.
Yeah, again, this doesn't change what the Fed's going to do. The Fed's still going to hike rates. They're still looking to hike rates 50 basis points in December. They'll hike rates 2 more times early next year. Target rate for Fed funds rate is around 5%. So the weaker inflation number, obviously great for stocks. They just needed some good news. Markets have been really beaten up this year, particularly in the growth sector of the market. So cooler inflation, better for growth stocks. So this morning we're seeing, Microsoft, Apple, Google, Amazon, those stocks performing very well. Doesn't change the outlook though for the Fed right now. Again, they're going to continue to hike rates unless we begin to see really strong disinflationary trends going into the beginning of next year, but that doesn't look to be the case right now.
And core inflation is better too, 6.3%. Can we talk about a peak on this core inflation, or is it too soon?
We've probably seen the peak in core. The reason is, and particularly in core inflation, the one thing that hasn't come down yet, but is about to, is what we call homeowners equivalent rent, and that is the housing component of the index, which makes up about 30 to 40% of CPI. That runs about a 3-month lag. So we're about to see a lot of the core inflation number, housing, auto prices, food prices, those will start to taper off here over the next 3 to 4 months. But again, those run a bit of a lag. So yeah, we've probably seen the peak of core inflation, we've probably seen the peak of actual inflation, and more importantly, the year-over-year comparisons now become very challenging. Going into next year, we'll start comparing to 1% growth rates in inflation from last year, which is going to start making things, really start to bring that inflation rate down. Probably by the end of 2023, I'm sorry. By the end of next year, we should be talking somewhere between 3.5% inflation, and the Fed should be pretty much done with their campaign.
And the possibility of a 50 basis point hike in December is now skyrocketing. What do you think? Do you see this race for the next month?
Yeah, again, like I said, the Fed is not going to change track right here. The expectation was already for 50 basis points. That was pretty much already built in. What this news says today is the Fed's going to hike 50 basis points, but that's better than if we had a really hot inflation number. The expectation would have been 75 basis points in December. So this keeps things in line with what the Fed has already said they're going to do and kind of what markets already projecting. So again, that's why it's playing favorably for the markets today.
And meanwhile, jobless claims have raised to 225,000 the last week. What do you think about it? What can we say now about the labor market? Because it's data that the Fed is looking at too.
Yeah, so the 2 things that the Fed really focuses on, obviously employment and then price stability. That's their two primary mandates, and employment has remained very strong up to this point. However, like CPI, there's a lot of lagging effects in employment. So we're already starting to see employment weakness. Again, if you just take a look, just this week, Facebook, Meta, announced 11,000 layoffs in terms of their company. We've seen Twitter lay off 50% of their workforce, kind of a special event there, but still layoffs. But we're seeing a lot of tech companies in particular laying off 10 to 15 to 20% of their workforce as this environment is slowing very rapidly. Now, we're seeing a lot in the growth stocks, particularly because that's where a lot of the hiring was over the last couple of years because of the pandemic, had a lot of hiring for services type jobs, et cetera. Those starting to get cut off. The manufacturing side of the industry or the economy, which is only a much smaller portion, that's about 20 to 30% of the economy, those jobs remain pretty solid right now, particularly with high oil prices and manufacturing still playing catch up with the supply chain disruptions. We'll start to see those layoffs probably later next year as these rate hikes from the Fed start to work into slowing economic growth. So again, jobless claims are very low right now, but the one thing to pay attention to and remember about employment data is employment data doesn't rise slowly. It spikes up very sharply. So once the economy really starts to slow down, we'll start to see the employment deteriorate fairly quickly.
And Wall Street is, of course, celebrating this inflation data. What can we expect on equity markets this last part of the year?
Well, history says that, and again, you have to be careful with history, but history says that technically the last part of the year tends to be fairly strong. Midterm elections came out as expected here in the United States. That should bode well for the markets over the next couple of months. We also have a lot of buybacks in the markets right now. So corporations have about $5 billion a day to buy through the end of the year. Now, that doesn't mean markets are going to go straight up. I would suspect that we'll see higher asset prices by year end. But in the first 2 weeks of December, mutual funds, we've got about 20% of mutual funds that have to make annual distributions. So we could see a bit of pullback, see a rally through the end of November, a bit of a pullback in the first couple of weeks of December, and then a rally into the end of the year as mutual funds, hedge funds, et cetera, all kind of rebalance their books for year-end reporting. So again, higher asset prices by year-end is likely, but it won't be a straight move higher. So look for some weakness if you want to add exposure to your portfolio. Look for some weakness in the first couple of weeks of December to increase some equity exposure.
Thank you so much, Lance Roberts. Has been a pleasure.
Thank you.
Pues